Let's talk Treasury yields. The world has gone mad. Everyone is freaking out. We've got the Russia-Ukraine conflict. We've got all kinds of chaos in various asset classes. And Treasury yields, they just look like they're going to the moon. Like they may beat Elon Musk to Mars. What's going on here?
Yeah, so I mean, we've been talking a lot about bonds lately, and people have been asking me, why are we focusing so much on Treasury yields, bond markets? If you're more of a Bitcoin analyst, and the reality is that these credit markets are really driving the performance of every single asset class right now. So I mean, everyone knows the story, right? Record high inflation, 40 near 50-year highs. Producer price index just came in at 10%, highest reading ever year over year. So right, something's broken and credit markets are telling you. And so fixed income is selling off in a big way. And what that means is the yields in fixed income and the price are inverse. So when fixed income investors are selling their bonds, the yields are going up. So here we have the Treasury market, which is still the risk-free asset in the bond market, the global bond market, and yields are soaring, right? Especially off of the 2020, 2021 lows. So what does that mean? It means higher discount rates across the entire economic system. So whether you're valuing an equity or whether you're trying to get corporate financing, higher discount rates can give you some trouble. And this is because of this inflationary environment. So we have this historically over-indebted economy with yields rising in a big way. And so I think that we're going to see some volatility in the coming months, maybe a year.
I tend to think that's exactly what this is telling us. If we look at the 10-year Treasury yield, the recent spike is obviously running counter-cyclical, if you will, or counter to the long-term trend, which since the early 80s has just been down and to the right. You've got this great chart here showing us this. What's going on, and why is this so important to understand why this is going up against the trend?
Yeah, so I mean, since 1981, really, we've been in this secular everything bull run. But really, what's driving this is the bond market, right? So lower discount rates, lower yields means the price of everything goes to the moon. And so basically, there's a few key drivers here, debt, demographics, but really what we see here is kind of a bunch of short-term debt cycles formulating a long-term debt cycle. So every time there's a boom in the economy, everyone kind of levers up, takes on credit. Malinvestment occurs, and then somewhere kind of in this 8 to 10 year cycle, this is more of just kind of an archetype debt cycle. There's somewhat of a crash. There's a credit crunch, a liquidity crunch, and some of that bad investment, gets liquidated, or there's a recession, right? But what happens after that is that the Fed, this kind of Keynesian economic system, they come in and they lower discount rates, they lower bond yields, and they kind of re-stimulate this economy. And so now, following 08, we hit that zero lower bound on the Fed funds rate. And so they did all sorts of things. They did quantitative easing. They did anything to stimulate the economy. And now following COVID, which was kind of this black swan economic event, they pumped a bunch more money in the system. Inflation's soaring, but they don't really have any tools left in the toolbox. And so now, even though the Fed hasn't raised rates, and they'll do it probably 25 basis points in the coming day here, the Treasury market's taking it, like doing their work for them, and the yields are selling off in a big way. And so we have this kind of 40-year trend in the making here, and if yields get any higher, it's gonna spell some trouble for the broader economy.
Got it. And so if we start to then break this down by the various types of bonds, you've got corporate junk bonds, the VIX, S&P 500, and looking at these, there's obviously relationships, whether it's a positive or negative correlation between these. What are you seeing here?
Yeah, so we have the high yield bonds, and then we have, like we talked about, the kind of the inverse is those yields, right? So you can see every time these kind of the bond market rolls over, specifically corporate bonds, and it should be noted that now we're in a time in 2022 compared to say the previous couple of decades, where more of the corporate bond market than ever, due to just kind of the amount of debt they all have on their balance sheet, are in this kind of junk rating, triple B rating. And the VIX, for those that don't know, is the S&P 500 Equity Volatility Index. So the higher VIX means trouble for equities. So you can see this pretty interesting correlation. As bonds sell off and as yields soar, volatility spikes and equities get killed. And so now, if you're just looking at the chart, looking at corporate bonds, they're really rolling over. And you see those yields, those junk bond yields really bending upwards. So that means higher financing costs. It means for this, historically over indebted corporates, they have to roll that debt over, and it's coming at a much higher rate. And so, and the crazy thing is, a junk bond, right? That means you're a poor credit. It means that you could default on your debt, but yields are only 6%. We have CPI that's going to come in here at 8% probably with this next CPI reading. So even before default risk, this isn't like a sovereign. This isn't the United States government. So they can nominally default. So even before default risk, there's a negative real yield. So yields have a long way to go, and the debt markets are still very, very mispriced. So what that's telling everybody is that unless the Fed comes in, and I think ultimately the end game is some form of yield curve control, there is a lot more pain to come in these debt markets, and expect volatility.
Expect volatility is a great way to put it. You've got a chart here of the Vanguard Total Bond Market ETF, and this thing just seems to be in a free fall. What is that showing you?
Yeah, so just kind of another one of these things to watch. BND is the ticker. It just takes basically all bond market and just kind of compiles it into one ETF, gives you exposure, and you get a kind of a coupon dividend payment if you hold this ETF. But really, just looking at the chart, especially since COVID, you see that kind of rapid fall, and then Fed comes in, saves the day, and a quick rebound. But this is falling off a cliff. So in terms of just like the overall market deleveraging that we're starting to see, and we're going to get to Bitcoin in a second, but just talking about the kind of the global liquidity environment, that the kind of across asset classes performance, deleveraging is kind of in the making here. And so it'll be really interesting to see what that pain point is for markets, for the Fed, for the broader economy, because it is coming. Liquidity conditions are tightening. Financial conditions are materially tightening. And it's because of this record high inflation environment where fixed income, kind of paradoxically, high inflation is not good for asset prices, because these fixed income instruments really, really sell off, and the second and third order effects of that are large.
Absolutely. We've got the Bitcoin kind of data as we've looked at this, and you've got the futures 3-month annualized rolling basis. And this just appears to keep going down over time, over the last, call it 6 to 8 months or so. What is that showing you, and why do you think this is so important?
Yeah, so I kind of have 3 prongs to my market analysis, especially with Bitcoin. We the first part, and what's driving really everything right now is the macro backdrop. And so we have kind of this long view, this thesis that the global fiat currency environment is so over indebted that the end game is essentially perpetual inflation, perpetual monetary expansion. That's the macro environment, and we're kind of in this secular or this little intermediate term kind of risk off environment. So that the macro is the first prong. The second prong is kind of the supply side dynamics on chain. We can look at all this really cool stuff. We have this secular adoption of Bitcoin, the asset itself. And the third, and it's really important for price action, is derivatives, right? And so you can see here during kind of the 2 bull runs we saw in 2020, 2021, we saw this kind of derivative market speculation really, really pick up. And so this annualized rolling basis, essentially what it is you can sell futures contracts for Bitcoin, and you can short this, and you can long the spot instrument, and you can capture kind of this risk-free neutral yield. So in April, you could get like a 45% annualized return by just selling 3-month futures, longing spot, capturing the difference. This happens in other commodity markets as well. You see like oil will trade, ahead of the current spot price or below the spot price, which is called backwardation. Ahead is called contango. So really right now, these contango yields are almost nothing. It's like 3% annualized. So it's trading like the 3-month futures trading like barely 1% over the spot price. So all of this kind of derivative speculation native to the Bitcoin, to the crypto markets, what this is telling you is it's gone. It's basically all gone. It's completely unwound since November. And so, there's not really kind of that chance for a huge deleveraging event. Liquidity event in the legacy markets aside, that speculation and that kind of open interest that leads to these really huge long liquidation cascades, it's looking pretty healthy in that regard.
Hey you, did you like this video? Great, we make 5 of them a day and post them here on this channel. Make sure you're subscribed, like the video, and see you next time.